Of late, there has been a disturbing trend in the spike of hardship withdrawals from 401k. So, we're going to talk about that today and maybe how you might be able to avoid that. Also, some reasons why you might wind up unhappy in retirement. One of them probably is obvious if you think about it, but there's a couple other that bear discussion as well, which we'll have later on in the program. And then, of course, the biggest mistakes that people make with their will. There was a great article in the Wall Street Journal. We put up that article on our LinkedIn page at Joel Garris, CFP, and thought we would spend some time on the program talking a little bit about that. So those are the topics that are on the board for this week's program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also one of the most listened to, because we come to you across a variety of stations here live on Sunday morning throughout the Central Florida region, whether it's at 9 a.m., the current hour, or whether it is at 11 a.m. over on the Space Coast. You can pretty much find us up and down the dial, north and south, east and west here in the Central Florida region. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary, and I'm with Nelson Financial Planning, where we've got a team of folks, all of which happen to be certified financial fiduciaries as well, but each has their own specialty. We've got a CPA, IRS enrolled agent, National Social Security advisor. That just is part of the great team at Nelson Financial Planning. So let us know if we can help you this coming week. Just simply visit our website, nelsonfinancialplanning.com, and you can fill out the Contact Us form, and we will look forward to visiting with you and seeing how we might be able to help you. So before we get to our slate of topics on the program, I guess it's always a good idea to recap the week that was. And that was a short week. If you were paying attention, you knew that the markets on Monday were actually closed because of the President's Day holiday. So it was only a 4-day week. And I guess based upon the performance and the headlines that came out this past week, probably a good thing that it was a 4-day week, because at the end of the day, the week started out with some better than expected employment numbers, which you would say, why wouldn't that be a good thing, right? If the employment numbers are showing continued strength in hiring and continued strength for the average working American, why isn't that a good thing? Well, because the Federal Reserve is trying to fight against that. They're trying to tamp down economic activity in an effort to curb inflation, doing so by raising interest rates. We certainly talked about that at length on the program over the course of the past couple of years in terms of kind of what they're doing and what they're trying to do. Unfortunately, the week finished with Friday's inflation data, personal consumption expenditures price index, one of the many different indexes out there that are used to measure inflation, came in on Friday up 0.6% from December. So a bit of a jump, 4.7% up year over year. So inflation is still running at close to 5%, which sort of is a problem if the Federal Reserve saying, hey, we really like that 2% inflation. Although in our view, that 2% inflation that we saw for probably the past 10, 12 years may be something that is simply not in the cards going forward. Why, you say? Well, globalization actually is a big part of that. When you're moving into a global economy, you find all kinds of sources of cheap labor. Well, they've kind of been explored or exploited, depending upon how you perceive. And so that additional workforce isn't really out there anymore. And then, of course, let's not forget the demographics. An aging workforce. Got a lot of people retiring, aging out, if you will, and in theory, demographically less coming behind them. So obviously, when you have inflation data, that certainly gets the market's attention because now it potentially puts the Federal Reserve more on pace for having to continue to raise interest rates. And so that obviously had a pretty significant impact and has had a significant impact. If you've been shopping for a car of late, you know that those interest rates on those car loans really have jumped up pretty dramatically. That's part of the Fed's doing to try and slow down economic activity. But needless to say, despite all of this effort, you have strong employment numbers, you have higher inflation. Scared the markets, if you will, because now there's that concern of, okay, well, is the Federal Reserve going to start to raise rates faster? We don't think so. We think they're still committed to a couple of more quarter point increases, nothing, but there is that concern that, oh, well, maybe they might go back to half a point. We think that's not really a valid concern, but be that as it may, the market certainly had a pretty tough reaction. 3% drop for the week that was. 2023 continues to show dominance of the FANGs in a very interesting, different sort of light. What led the market in January also is leading sort of the subsequent February slide. In fact, 75% of the performance in the S&P 500 is just from those 7 or 8 countries that we affectionately refer to as the FANGs: Facebook, Amazon, Netflix, Google, all those kind of tech companies. So with that backdrop, we thought it would probably be a good time to sort of highlight some reasons for optimism, right? Stronger economic data, which could potentially lead the Federal Reserve to continue on an aggressive interest rate raising path. Certainly a tough negative reaction out of the markets this week. But what are some of the silver linings that we see out there? And I think the first is this connection between market declines and earnings drop. The reality is that research shows that when markets decline, they usually decline somewhat similar in terms of percentages to the drop in corporate earnings. Because remember, over time, that's what the market truly reflects, right? It's not just some arbitrary made up number, but in fact, it is a number that reflects the value of those companies that are publicly traded in the market. So if you think of it, earnings, which is companies making money and how much they're making money, would kind of be a primary factor for how the market is driven, right? So if you look at historically, though, when you see earnings decline, typically in recessions, you also see market declines of similar nature. For example, in 2008, there was an earnings decline of about 40%. Well, guess what? The market went down by about 39% from the peak to the low in March of 2009. Similarly, now, if you kind of fast forward to where we are right now, last year, the S&P for the calendar year was down about 19%, but profits were actually up about 6%. So that's probably the biggest reason why we saw sort of a stronger start to the year. And ultimately, our thought is that the markets last year might have been a little bit in front of what ultimately we will see this year. Typically, when you look at market declines and recessions, you can see a 20 or 30% drop. If you look at where the markets were in September of last year, right at about a 23% drop. So in our minds, that's some reason for some level of optimism in terms of where the markets are relative to where we might expect them to be. We're going to continue this piece of the conversation when we return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Helping to give some perspective in terms of some reasons for optimism, even after some of the headlines this past week that showed stronger employment data. That's actually kind of a good thing, isn't it? But the other part of it was continued high inflation. Friday's numbers, 4.7% on the inflation gauge that the Fed kind of likes to look at, suggests that maybe the Fed might have to continue its pace of rising interest rates. And I think the key word there, it's pace, which means that they probably do have a couple of more quarter point increases, but this notion that they'll go back and start raising rates by 50 basis points or 75 basis points, I think that is not in the cards, because so much of what they did last year still has not sort of made it into the economic soup. Remember, these interest rate hikes take about 6 to 9 months to ultimately show up in the economic data. So you're just beginning to see some of those rate increases that happened in the first part of last year now showing up. One of the reasons why we think that there's some cause for optimism is you think about profits, and this was the data we were talking about before the break. If you think about profits and how markets respond, research shows that the decline in corporate profits often mirrors the decline in the markets. And that should sort of make sense, right? Because the markets, after all, are simply a valuation of those companies that are making stuff that in a recession, maybe they don't sell as much, or maybe that cuts into their profit. Hence, in earnings decline over where they were previously. If you look at 2008, 40% drop in earnings sort of almost directly corresponded with a 39% drop in the market. Last year, interestingly, it was actually a 6% growth in earnings. Meanwhile, the backdrop was that 19% drop in the markets as measured by the S&P 500. So our theory or our thesis is, well, at some point, yeah, okay, profits are going to drop, earnings are going to drop, because you can't raise interest rates at the pace with which we've been raising interest rates without there being some kind of an economic impact. But if last year profits actually went up by 6%, but yet the market went down by 19%, maybe the market was kind of getting in front of the news of what will play out during the course of this year. And if that's the case, well, that should make sense, right? Because we know that the markets have a tendency to be anticipatory, looking out 6 to 9 months and saying, okay, what's the landscape going to be? And so there's a lot of folks that are looking at the data that was happening last September, where the markets actually were down almost 23, 24%, that says, okay, well, that starts to look like a normal profit earnings type of decline that you would see in a recession. So might that suggest that a lot of the potential recession, which, by the way, as we've certainly talked about many times before on the program, it's a normal part of the economic cycle. It's not anything that you need to get overly concerned about, because if you still got 10 years, 20 years, 30 years left on this good earth, then guess what? You'll see another recession or 2 or 3, depending upon how many years you've got to go, because history tells us that they are a normal part of the economic cycle. That's why it's called a cycle. There's periods of time where it expands, and there's periods of time where it contracts. Well, guess what? The good news is that it expands an awful lot more than it contracts. So just some thoughts in terms of kind of the relationship of profits or corporate earnings to markets and sort of where we think we are at this point in time. The two other comments that we would share is that higher interest rates aren't necessarily awful for investors. I think this is some suggestion of, high interest rates, you're not going to make the kind of returns that you would if interest rates were low. And there's probably some truth to that statement. But the reality is that if you think about Treasury yields over an extended period of time, typically not uncommon to see them around 7%. Today, for example, they're at 4. So we're still a long ways from 7, because we're still at 4 in terms of those yields. But certainly during those periods of time where you've seen higher Treasury yields, you still saw a lot of economic growth. And remember, it's the economic growth that ultimately drives corporate earnings, corporate profitability. And then lastly, of course, let's not forget about January. Here we are wrapping up February. We'll flip to March this coming week. But January, for the month, the markets were up about 6%. How markets perform in January is usually a pretty good indication for how they're going to go for the rest of the year. If it's an up January, 70% of the time, the rest of the year winds up being up. So we want to just kind of share some of those points or data points, if you will, for consideration, particularly after a tougher week for the markets last week, to help give some perspective as to what also is going on out there in the markets as a whole. So welcome on into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out, whether that's on your favorite podcasts channel of choice or on our YouTube channel. Have any trouble finding us on any of those favorite platforms like Spotify or Amazon or iTunes or even YouTube? Go to our website, nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and voila, you will get instantly connected to the channel on the particular platform that you are looking us up on. So, my name, of course, is Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning. So one of the things, speaking of the internet, we posted a couple of articles this past week on our LinkedIn profile. So make sure you connect with us over there on LinkedIn as well. One of the articles we posted had to deal with the annual ranking, if you will, done by Barron's Magazine of mutual fund families and who ultimately had the best overall performance. For those of you who don't know, Barron's Magazine, one of the preeminent weekly publications in the industry, very highly regarded, very well respected. And certainly, I opened up the Barron's Magazine last weekend and was particularly intrigued because obviously, while you don't want to get too hung up on rankings, the reality is that last year was probably where that ranking might have carried a little bit more weight, right? Because you want your investments, you want your fund managers to be doing particularly well in bad years, right? Because you want the losses to be minimized. Because we all know the bad math. If you suffer a loss, it takes a lot more on the upside to recover and recoup back to where you were. That's the tricky part of math. When you lose 20%, you got to make 25% to get back to where you were. So performance really matters, particularly in a bad year. And so what's interesting about these rankings is that it really looks at fund companies that have sort of broad cross sections of available funds, meaning it's not looking at, okay, they just do large growth or they just do international. Really, it does kind of look at a broad cross section of different options. So in order to play in these rankings, you've got to have a pretty broad-based investment process, which I think fundamentally, in my mind at least, speaks to the process that you have, that ultimately your investment process and how you choose investments is a solid one that's based upon picking the right companies, picking the right bonds, and ultimately managing risk, right? So managing risk, pretty important last year, particularly in a down year. So in order to sort of do well in these rankings, you've got to sort of do well across the board. You've got to be able to perform across all the asset categories, which ultimately leads to the process in place. So pretty important stuff. The question is, and this is a question we asked on LinkedIn, how did your fund manager do? Check it out on LinkedIn. Look me up under Joel Garris, and you'll find the article from Barron's. We're going to have a couple of final thoughts on this piece when we return from these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're asking the question on the program, where do your fund managers rank on the latest Barron's ranking of mutual fund companies? Every year, the folks at Barron's Magazine, one of the preeminent publications in the financial services industry, kind of goes through and ranks the different mutual fund companies, about 50 or so different investment management mutual fund companies actually qualify, because you need to have a broad cross section, because the rankings are really designed to look at the process that the investment managers, the mutual fund managers actually are using at the firm, along with how they minimize risk. Certainly last year, with a decline in the markets, a very important year to be minimizing risk and having the right process. So where does your fund manager, where do your fund families rank? Well, we posted the full article courtesy of Barron's on our LinkedIn page. So go to LinkedIn and look for my name, Joel Garris, and you'll see it. And so make sure that you check that out to see exactly what the story is. Every year, of course, Barron's ranks based upon the past year, but also more importantly, because remember the 1 year, yeah, maybe you got a good year, maybe you got lucky, who knows. But they also rank on a 5-year and a 10-year basis. So obviously, you want to pay particular attention to those longer term periods in order to properly get an idea as to how your particular fund manager is doing. Certainly nice to see, as we do every year, that the fund families that we use, that our clients own at Nelson Financial Planning, once again ranked in the top 10 in terms of percentage. That would put them in the top 20%. So certainly some good numbers across the board. But make sure you check that out on our LinkedIn page at Joel Garris, and you'll see the full article and see where your fund manager ranked, or hopefully they did, right? If they're at the bottom, that might be a problem, right? Anyway, this, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Like, for example, am I owning the right mutual fund companies for my investments? My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a whole team of folks, all of which happen to be certified financial fiduciaries who stand ready to help you improve your life with a successful and cost-effective financial plan. You know, during the break, listening to the ad, there's certainly a lot of major life events that happen, it seems like almost on a regular basis, right? Changing jobs, retiring, receiving an inheritance. Maybe your current advisor retired as well, or they changed companies, or you simply want a second opinion on what you are doing now. The best way to reach us, give us a call, 407-629-6477. That's the office number where we have live people that actually answer the phone, along with, of course, our website, which is open 24 hours a day at nelsonfinancialplanning.com. Also, I don't know if you happen to be scrolling around the dial last night on a Saturday evening. I actually just so happened to be quiet Saturday evening at the house, and lo and behold, stumbled across the television program Best of Central Florida. It was airing last night from 7:30 to 8, and in it features some of the best family-owned businesses within the Central Florida region. Well, lo and behold, there we were, the People's Choice winner, Nelson Financial Planning. And so make sure you check us out on that as well. I think probably tomorrow we'll post up something on Facebook and the website so that you can check out the video and certainly get that out. But once again, recognized, courtesy of the folks at Best of Central Florida with Justin Clark, that ultimately for that particular category, it was best family-owned. And obviously, since 1984, we've been a family-owned business. One of the things that gives us the ability to be as independent as we are, because there's no big giant mothership, if you will, hanging out and watching what it is that we do. So once again, happy to be recognized by the folks at Best of Central Florida as the People's Choice winner, this time for Best Family-Owned Businesses. Speaking of family, how's this for a segue? Let's talk about your will, and particularly some of the biggest mistakes that people make about their will. This article comes to us through the Wall Street Journal, also posted on LinkedIn as well. So oftentimes what we will do when we're talking about a particular article on the program, because we think it's important and we want to share with you more of the details of the article, we'll post the full article on our various platforms. So that way you should make sure you're subscribing to us on venues like Facebook or YouTube, or connect with me on LinkedIn, because then you will get the opportunity to see these articles and be able to read them for yourself to give you a little bit more information about what it is that we're talking about on the program. Because the reality is that this is, I think it's like 42 minutes because of the commercials and stuff like that. So it's hard to get through everything in detail, but we try and just hit some of the highlights. So go to those websites and make sure you subscribe to us, and you'll get the full breakdown on exactly what is happening on some of these articles or some of these topics that we talk about. Anyway, this one struck me. This one struck me because as we go through this, I'm going to highlight one item that particularly struck me. That was the story that we shared on the social media platforms this past week. So here we go. Some of the biggest mistakes that people make with their wills. Well, first one's obvious, right? Procrastination. Procrastination is the first mistake, because that's the art of putting it off and not actually doing anything with it. You don't bother to create it, or you create it at the last minute, or you create it when you're on your deathbed. Boy, that opens up a lot of opportunities for people to try and challenge it. If you do that, the reality is that the notion of procrastinating and putting it off never really works. The number of times that we get this call at the office for folks that are like, okay, I'm traveling, I'm leaving next week. Okay, but I don't have a will and I need to put it together. I'm like, yeah, that's kind of the definition of procrastination, right? It also increases the propensity to have errors or unintended consequences, because if you don't think it through or spend the time thinking it through, you can certainly have that. So the number one issue, or the biggest mistake that people make when it comes to preparing their will, yeah, you guessed it, procrastination. But there's a bunch of others, and that's the rest of it that we want to kind of get in on the program today. So next up would be this notion of dropping large inheritances in people's laps, right? That is just rife with problems, because if you choose the easy button and you bequeath it outright, well, if the beneficiary is 22, that may present a little bit of a problem. They may decide to take the rest of their 20s off and enjoy the money. The problem is when they try and re-enter the workforce a decade later after the money's all gone, then they're going to be 10 years behind in the workforce. So in that case, sometimes it's easier to better to spell things out. And you do that through using a document that would supplement that will, and that would, of course, be a trust. We're going to talk a lot more about this, but we got to slide to the break. When we come back from the break, we're going to talk about all of these issues at length. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. About some of the biggest mistakes that people make with their will, first and foremost, of course, would be procrastination, right? You put it off and you don't actually do it, or you do it so quickly that you create unintended consequences. So that's probably the biggest mistake, is just not bothering to do it. There's a host of other mistakes, which we're going to talk about in this segment here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We happen to be one of the top 25 financial planning podcasts on the World Wide Web as well. So make sure you subscribe to us on your favorite platform. Have any trouble finding us, go to our website, nelsonfinancialplanning.com. Upper right-hand corner, you'll see the icons. Click on the one that looks most familiar to you to get instantly connected. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great people who also happen to be certified financial fiduciaries that stand ready this week to help you improve your life with a cost-effective and successful financial plan. So what are some of those other issues that can happen with your will and mistakes that people typically make? We started talking a little bit about this before, but the reality is that dropping a ton of money into a 22-year-old's lap can also lead to a lot of mistakes. The reality is that large chunks of money that ultimately go directly without any strings, without any parameters, can often lead to enabling bad behavior, or should we say lazy behavior, that ultimately undermines everything that you've worked for. So know the unintended consequences of dropping a large amount of money in someone's lap. The way to avoid that, and this is why you can't really procrastinate, because if you're trying to avoid that, then that requires a much more sophisticated legal structure rather than just a simple will that says, I leave everything to these 4 people divided equally. In the case where you want to put some strings on it, some parameters on it, well, guess what? That means that ultimately you're going to need some type of a trust structure that determines, okay, it's not going to go as a big giant cardboard check, but rather it's going to go over time, and there's going to be certain parameters or metrics that the beneficiary may need to actually meet in order to receive the money. Next up would be sort of forgetting about accounts. And I guess that's easy to do in the online world of which we live in, right? Everybody's statements are coming electronically. So maybe you get that bank statement electronically, but maybe your beneficiaries or your extended family don't really know that you've got an account at that particular financial institution. The only way that they would know that is if they were checking your email. So make sure you also take the time and list out kind of where everything is. We've talked about this in prior programs where we made the suggestion of having some type of a fact book, a detailed book that spells all of that out, including points of contact and those types of things that you would find useful to sort of track down where things were, given if you're not around, right? Because you're dead, and so people can't ask you any questions. Next up on the list of the biggest mistakes that people make as it relates to your will would be not making regular updates. And this is sort of a common theme where folks that actually did get around to doing a will or maybe even a trust, they sort of set it and forget it and they don't take another look at it. Well, the general rule of thumb is you want to be looking at reviewing those documents every 5 to 7 years, because things change, things happen. People get sick, people get married, and you got all of these other external factors that can happen over time. That's why it's so important to sort of look at these documents on a regular basis, because you may want to be updating it along the way. Next up on some of the mistakes that can happen, and this one is one that we talk a lot about on the program, and that's this notion of mismatching beneficiaries. People think, oh, I've got a will or I've got a trust and it names A, B, C, and D, and that's great, and I got nothing to worry about. That is true up until a point. And that point is when you have accounts or investments that where you have the ability to name beneficiaries. So in this case, think retirement accounts, think payable on death accounts, think insurance policies. All of those typically have features that allow you to name specific beneficiaries on each of those. Well, here's the thing. If anything happens to you, whoever you've named as a beneficiary on any of those types of accounts is going to get the money regardless of what your will or trust says. And that comes to a surprise as a lot of people. But the reality is that when you name a beneficiary, it acts by operation of law. And that means that it's going to trump what you said in your will or trust which acts by operation of contract. And so there's two different legal standards in there that play. Naming a beneficiary is going to be the one that trumps everything. So that's why you make sure you check all of those beneficiaries as well and make sure there's not a mismatch of who you've named versus who you've put in the document, the will, or the trust. Also, it's important to create some flexibility, right? If you don't allow for flexibility, the reality is that things change. And so you want to have some certain level of flexibility, particularly as you write these documents, if you're concerned about the disbursement of funds over time. And then lastly, and this was when we posted the article on LinkedIn earlier this week, this was sort of the story that we told in posting it. The last one, it talks about not heading off conflicts. And everybody thinks about, oh, well, I want to head off these conflicts in my lifetime. But the reality is that when you pass, you're talking about a highly emotional period of time. And that can often be where those increased emotions lead to increased conflict, or perhaps the conflict coming up to the surface, if you will, in those conversations. And I'm reminded, as I said when we posted this article, that several years ago, I was serving in the role of trustee and executor, which was something that we do from time to time when folks ask us to serve that role. Although this was one of those times when I'm like, maybe I don't want to do this because this was not a particularly happy family situation. The normal dynamics that happens when one child is the caregiver and the other children aren't, and then it becomes this whole speculation of, well, weren't you, maybe taking advantage or using the money for your own benefit, things like that. Well, we happened to go on site to kind of do an inventory on one of the properties, and lo and behold, one of the beneficiaries proceeds to brandish a handgun. That is exactly why you want to make sure that you've spent some time heading off conflicts before you find yourself in that position, or you find that the trustee or the personal executor finds themselves in that position. So make sure you take the time to have the conversation in order to head off those conflicts before they happen. Well, that's about all for this week's episode of Dollars and Cents with Joel Garris of Nelson Financial Planning. If you like what you heard and want to learn more about how we can help you, visit nelsonfinancialplanning.com or call the office 407-629-6477 to schedule your absolutely free personal conversation. And remember, we don't believe in account minimums at Nelson Financial Planning because our purpose is to help you get a better financial plan.